Good afternoon, everyone. It's 5 o'clock sharp, so time to start our second webinar in a series of 4 on financial management for social entrepreneurs. For those that are joining us for the first time today, I am Luísa Ferré, and I'm head of the social program at European Investment Bank Institute, and I will be your host for today's webinar. And it's my pleasure to introduce you to Thomas Ferré, that is the speaker for the 4 sessions on the topic of financial management for social entrepreneurs. Thomas works at European Investment Fund's Mandate Management Equity team, and he is a former social entrepreneur himself with a previous career in venture capital. So the right person to answer any questions you may have on financial management topics. In this second webinar, Thomas will walk us through the valuation of your startup and what you need to do before talking to investors. And I now invite Thomas to join us. Thomas, the mic is yours.
Thank you, and glad to see you again from the last webinar. We had an issue during the last webinar, so actually, that's okay with everybody. I'm going to turn my video off, and this way we won't have any issue with the sound. I'm absolutely fine with not seeing my face on the screen. So hopefully we'll be able to all focus better on the slide and have just a better audio experience. So thank you, Luisa, for organizing this and for inviting me to lead these this series of webinars of 4 parts. And these 4 parts are designed to help entrepreneurs, that's our target, think about various elements around fundraising and the financial management of their impact startup and their startup in general. The basis, the 2 biggest elements of this series of 4 webinars, fundraising valuation session, which is today, and the business framework and model, which is next week. And the session number 1 before that was to introduce the concepts around investing from a VC standpoint, understand the difference between debt and capital. On financial management of certain KPIs that may kill your company without you realizing it. So before going into our that we talked about last week, during that the course of that 1-hour session, we talked about debt versus equity and how founders really need to understand the difference of those 2 financing instruments, because as they grow their company, the capital structure of your company is going to be more complex and have a lot of implications in good and bad times. And understanding what's the profile of investor at various stages and in various elements of your capital structure really allows you to better focus on what's the priority type of financing that you should seek. This led us to understand that to present VCs and understand that VCs are return maximizers and risk minimizers investors, and they invest in businesses that have an over 80% rate of failure. So their approach is really to invest in the return maximizing element of the capital structure, which is equity funding, with a lot of debt features to minimize their risk. We also talked about the cap table, how it's an important document as part of your fundraising and your capital structure. And in fact, today, we're going to go through an example of building a cap. And then finally, last point I wanted to remind you is the main important point of all these series is that we're introducing a lot of concept, but a lot of this information is online, available for free. So really use this webinar as a starting point and spend time exploring some of the references and the links that I share with you, and also just looking up on your own through Google and other databases and online sources on what the best practices are for various elements, whether they're legal, they're on Excel, or certain practices around concepts little bit of a poll, and here, Denise, I call on your expertise as a star organizer. I wanted to understand how, from the audience perspective, you would be looking at valuation, and in other words, how do you value a startup? This is a topic we're going to talk about today, but I think it's important to take stock of how people look at it. So, would you get the highest amount that you can get as a founder? Would you benchmark against peers and then say, you know, based on my peers, I think this? Would you negotiate price of investors that you already know? In other words, I have a few people that I know, I'm just going to talk to them and, you know, tell them a price, they're going to give me a counter offer, and then we're going to invest based on this? Or are you going to calculate based on a sophisticated model of revenue, what the team value is, what it brings, the growth, your opportunity cost, market potential, and various elements? Or just, you know, wing it and then consult your 8-ball and just come up with a price. So
71% of the participants just calculate the approach.
Okay,
based it on
well, that's pretty good.
revenue. So, and the remaining, but 14% goes for the highest amount they can get.
The reality of valuing a startup, there's a lot of things that go into it. And certainly the best deal that you can get, because evaluating a startup is one thing, but signing an investment term sheet and signing an investment contract has a lot of components with it. And so if you have a high evaluated terms, then it's better to have a low valuation sometimes. So let's take a look at the key concept we're going to talk about today. One is rule number one: VC says it's about a team. You always hear this. So for you, you look good when you're prepared. So I really encourage you, like I mentioned in my recap, being prepared, researching, spending time, etc. We're going to go over this. Second one is VCs, as I mentioned, are return maximizers and risk minimizer. So they look at both sides of your business. One is your upside forecast, their valuation component, the risk and probabilities of success and failures. They also look at, we're going to go through the math today. Third is the cap table. Now, a cap table is a very simple tool. It's a very essential tool, and it needs to be updated every round, and we're going to go through the math of it today. And then the fourth element sort of goes back to element number one, is that it's important that evaluation is something that you may calculate on paper, but with market practices, talking to investors, how they look at it, etc. And don't spend too much time fundraising. We'll talk about it again. Repeat something that I've said already twice, but before you start anything, do your research. I've got four quadrants here. Talk about 4 elements of first. You're building a company. So for most of you, you're building a company that eventually you want to be sort of a lower mid-cap or mid-cap. You might think about doing an exit on the public markets. But essentially, you're thinking about building a company that's going to employ 50, 100, 300 people, perhaps more. And it will companies that are publicly listed. So I really encourage you to go on Yahoo Finance, look at, in the US, there's a lot of publicly listed companies. The requirements for reporting, as I mentioned, webinar number one, are quite stringent. They have a lot of documents from research analysts that talk about how they're valued, from their annual reports, whether the ones they send to the SEC, called the 10Ks, the annual reports, or their annual presentation that will talk about their KPIs, the market segments, industry best practices, what kind of tools they use. Useful for you to understand your small company. If you're going to be a big company, what do you need to look at? And what's the process? You'll understand their balance sheet, etc. I've talked about this already in webinar number one. Second quadrant on the top right, private market comps, comparables. So you have to look through Crunchbase, Seedrs, AngelList, and a lot of other databases that help startups find investors. You'll see valuation sometimes. You'll see how many rounds they did, what was the pricing. You'll get a sense of, for specific industries, what kind of traction they get, etc. And so that'll give you a lot of market feedback as to what's the right valuation based on comparable. A third in the bottom left is once you say, well, I've got elements to make me feel like my valuation is pretty solid, I have a pitch book that's solid, go figure out what investors you're going to talk to and what they've already invested in. So look at their portfolio. All the VCs have their portfolio online. Look at who they've invested in. They invested in your industry. If you have a fit within their product, get advice from their entrepreneurs, network with entrepreneurs that have received funding, understand the thought process of these VCs. It's very important, and it's something that you can do ahead of time to already sort of pre-validate that a VC is interested in you and that you're interested in them. And then the bottom right quadrant, which is sort of the essence of your pitch book, is really understand what investors look at, because that will affect a lot of their valuation of your capabilities. And so the first element is always team. I'm going to talk about it in actually one of the next slides about, in particular, how it applies to zero revenue companies. Another one they'll look at is innovation versus competition. You know, how, if you're entering a very competitive market, what's the point in investing? What's your added value? What do you bring that's not already there? A third one is industry knowledge. How good is your team? How good is the investor's knowledge on your industry? I think that's a very important element of your conversation. And then there are also look at market potential, how far you can go, your growth, your traction, your customers' retention, how many clients do you have that you lose, or do you just keep your clients and you keep them for a long time? You're going to look at your profit and impact strength, and this is really how, you know, in good times like in bad times, do you still are you still capable of generating? They're interested through their investment in you, and then your moat, and your moat is really your competitive advantage and the barrier that you've set around your business so that nobody can. A very important element of your business. I'm going to talk, before going through the math of how to value like a startup like a VC does, I'm going to talk about 4 profiles of companies. The first one is a no revenue company. That's a high growth company. And here I encourage you to think about, you know, what was Facebook valued like? What was Twitter valued like? And in reality, they didn't have revenue at the beginning for a long time. In fact, Facebook was valued at $2 billion before IPOing. And a little bit more, they valued WhatsApp at 20 billion. And the metrics that they used to value those companies were really on a per user base. So investors would say, in the stock market, what are the companies that aren't generating a lot of revenue? And these companies, really, we invest in them because we think they're a platform for a user, and that's going to be monetized over time. That was the case of Twitter and many companies. And what it brings you back to is metrics. What kind of metrics do you use that you can compare to other businesses? Now we're building a business. We need funding because the better way to build this business is not through monetization, but we're going to do that later through through various elements. And but we have an enormous amount of traction, and so because of that, VCs will say, you know what, I love. They really want you, they need you. And so at some point we'll be able to monetize that, and I have no doubt. So this is one example. So think about metrics of traction with users and clients, of people who use it, and how you're going to be able to monetize it. And this will be a basis for evaluation. Another type of company in the second box is the deep tech and drug development. And here I think it's always a tricky thing to value. It's always a tricky thing for people who are not experts. What we find is that there are experts that invest in value in companies with a long lead time of development that get various types of funding, like grant funding, like equipment financing, like grant, whether it's a tech or a university or a government grants, etc., or foundations, and then they start doing debt investments or perhaps equity. These companies have specialists that do these investments and specialists that manage these companies. And so they together are able to really understand what have been the market practices. And here it's really just about market practices and kind of investments of your product. So if you're in this case, I really recommend that you talk to specialists. In your industries, it's really too broad to make a general case about how to value these companies. A third type of company to talk about is, let's say you have a company that's a SaaS company, it's generating an impact, it's generating a few hundred or perhaps even a few million of revenue, but a few years. So at this point, it's more of an SME, if you will, a low growth SME with high margins, good profitability, etc. Typically, these companies get valued, on two metrics. One is in the eye of the investors that are interested in these mom and pop business or turnaround specialists or private equity who might do a buyout, etc. That might be one type of investor, and they might use the PE ratio, which is a typical, if you will, public equities ratio, price to earning ratio, the price of a share based on its profit per share. And so when you have a PE ratio of 10, essentially what it means is that you're willing to pay 10 times the price of a profit per share for every share that you buy. And another way to look at it is that you're essentially paying 10 years worth of earnings at this share price, earnings generation, if you will. And so if you're buying at 15 P ratio, it's 15 years of earnings. 5 P ratio, it's 5-year earnings. And this brings you back to when you invest in a business on an equity side, you're trying to get access to buy a business because you're at a P ratio of 10, and you're essentially saying that you think that you can get more over the next 10 years than these 10 years, with interest rate taken into account and whatever you can get on the market if you were to invest somewhere else. So this is an important concept to understand. And the fourth bucket is the high growth young startup. And there's many ways that people look at them. There's comparables, there's discounted cash flow. We're going to spend time on the VC multiple approach. And so that's our next 3 and 4 slides. So let's say you're a startup that started about a year, 2 years, 2 years and a half ago, and you've already grown quite in annual recurring revenue. Now, annual recurring revenue is an important term because this is how people value startups. They think it's not one contract that you have. They're thinking really recurring revenue, a way that show that your clients are stable and they're constantly paying you for the service. Certainly, there's more to SaaS, software as a service. Familiar with this in minimizing the client's evaluation phase. So generating 150K AR today, and you're approaching a VC and a bunch of investors saying, I'm going to raise 300K, and they're going to say, yeah, great. What's your valuation? You're going to say, well, let me run you through the concept, and you're going to do the math that we're doing today. So first, you're going to say, here's my business model. I'm showing you my evolution of revenues every year for the next 7 years. And you look at 7 years, we're going to generate 100 million. I've got all the plans to prove it. And here's my plan to grow it. Amount of people, we're going to go here, there, etc. That's really cool. I want to have a conversation with you. And I understand where you're going from, planning for $1 million in revenue. I think it's in revenues. And me, why? It's because you're planning to grow through a number of large cap clients, which are corporates, and these big corporates might take 3 years before they sign a contract. The first call or first product demo until they sign an official contract, it might take them 3 years. Some of it might take them even longer because they'll ask for 3 years of audited financial statements from you, and so you won't be able to be a candidate. Some of them will automatically. So the point is, your 100 million might be achieved in year 9, and so the 70 might be more of a realistic goal. They'll talk to them. Eventually, you agree. Okay, 70 million. Everybody's on. They'll do together. It's hard to value 100K and 100 today. We'll just public markets. And so looking at the public markets, and here again, yeah, it's a great resource to find these kind of numbers. Capital IQ, other paying databases will give you the same gap financing. And you can search through a lot of companies, all the companies in fact, listed. And the VC, if you haven't done the work before, will basically take 10, 25 companies by industry, by size revenue, by profile of growth. Based on profit, but here we're trying to. And so what we realize is that these companies are, on average, enterprise value at 4 times their revenue. And so we think your 70 million in 7 years is worth you being 280 million as an enterprise value in 7 years. You're saying, oh, that's really cool. Now, keep in mind, this is enterprise value. Now, this is a technical term. Enterprise value is essentially the value including the cash. So you know, when you're going to be in 7 years, around Series C and Series D, working capital. Your equity is going to be worth 80 million. In fact, we estimate that it's going to be, you're going to have 60 million in cash. So we think he's going to be 220 million. Yeah, well, not too bad. So we've gone from 150K revenue today to a company in 7 years could be worth 220 million in equity value if you achieve that annual recurring revenue. Now that's looking at the bright side of the picture with some adjustment. But if you see return maximizer and a risk manager, look at the downside. Now, before we go into looking at the downside, let's understand a little bit about how VC venture capital fund works. Venture capital fund is essentially a team of people that go to pension funds and to people who invest the money for a living, governments, pension funds, retirement pension funds, or foundations that invest in or high net worth or retail investors, and tell them you're earning 8%. Random products. I'm going to sell you a share in my fund. and I'm going to target 25%. It's so much bigger. And I'm going to invest in new technology. I'm going to take a little part of it. So we're selling you 25 return on your investment, give me your money. And they pay the VC team 2% on the total amount of money in the fund every year. So suppose you're an investor in the VC fund, you're going to give them 100. So if you look at that table, you're going to be down 100, you're 0 minus 100. And then every year, if you get a 25% IRR, the unrealized value, so the value of your 100 is going to represent year one 125, which means if you exit in year one, you would have 25, year 125. In year two, it would be 6 times your initial 100. Yada, yada, yada. In year 7, it would be 4.77 times your 100. Now, if you've ever seen The Big Short, this might explain to you a scene in The Big Short, the movie about the financial crisis, where one investor betted through the movie, and at the end he points a 485% IRR. This is the number that we're talking about that would compare to the 25%. So here, basically, fund manager, the VC fund manager, is saying that on average for all the companies in his portfolio, he needs to be able to return 4.77, whatever money he's raised. And so that means that if we take an individual look at companies in its portfolio, you're taking the 220, and he's automatically going to say, yeah, that 220, I need to earn a cash multiple of at least 4.77. So that 220 really, if we bring it back to today, 7 years, it would be worth, I would invest 46.12. And so you're thinking, that's really cool. My business is worth 46.12. No. That's what he wants to earn on a company that's successful. As we talked about the table on the right, here, 300K, this looks more like a seed round, or perhaps a Series A. It's really a 90% rate of failure. So he's going to say, failure risk is around 90%, and so I risk more. How does he get his 10? Well, failure risk of 90% means a success rate of 1 out of 10, which means that every 10 company he's in, 1 is going to survive. So is really adjusted 4.61. Now, I think this is coming a little bit more to terms with the reality of your 150K and your high growth trajectory, but it's still not quite there. Because what you see on the table on the right is a number of series, and each series means dilution for your investor. So they're going to say, yeah, but I'm investing this, I'm going to be diluted, which means that over time, my percentage share of your company is going to go down. So if you invest valuation of 6, dilute me over time with these my 1%, 0.5%, 7 years. So I need a dilution multiple of 2x. So this is how you go from 150K in annual recurring revenue that will be worth an agreement to VC 7 million in 7 years to a 2.31 post-money valuation. So 2.31, if you're raising 300K, that's the post-money valuation, which is the money that the investor, the value of your company, the investor has invested. I'm going to let you some time. Obviously, this webinar is going to be available online, so you're going to be able to certainly pause and go back through the calculation. And so what that represents is a cash multiple on 95x. And again, you have to cash multiple with the failure rates of the startups, the state company that you're using. Look at the cap table, which really brings together this round from pre-money, which is the valuation of your company before money, to post-money, which is your equity valuation after your money and after you've put the money in your account from your fundraise. And let's take a look at that simple tool, what it means to how to organize from one round to another, the ability to understand 2.1 a seed valuation. Capitalization table before the fundraise. Let's assume you had 100,000 that all of your founders, let's just say you, were 100% owners of. It means that in your total founding round shares, and you had 100,000 shares were owned 100% by the founders. Now, we talked about your implied equity valuation today. This means that the validation of the fundraise essentially set a price per share, PPS on the bottom left, of 608. It's a approximate number that you see here, 2.01, divided by 100,000 shares. So just through the fact of you've established a pre-money valuation that sets a price per share, price of your company pre-money. How do you essentially have 5 investors, investor 1, investor 2, investor 3, investor 4, and investor 5. And let's say all of them has a different amount of money. You've got the lead investor putting 20, and second investor putting 20, the third will put 50, the fourth 20, and the fifth 10. You can have more, you can have less. It doesn't really matter. How do you go from this section money evaluation to the post-money seed round information? Essentially, we all agree that we've now set through this fundraising a price per share of 20.0608. It's in blue, right above the pre-money label in the left part of that table. So you can put that in the right part of that table, 20.0608. That's the post-money price per share. You've also established you're raising 3, and so you can show that the seed investment for all these investors, including you, is a total of 300,000. Is that those 3,000 are buying at 8, and so that means that just a simple math will tell you that based on the price per share, you're essentially raising, creating shares. So total number of companies in total number of shares in your company after dilution would be 114,000. Same method allows you to understand how many of these. The same math, the same process is done for a Series A round, a Series C round. So hopefully, I'm going to let you just take a look at it for a couple of seconds. It really time to talk about the impact side of valuation. So here I'd like to issue our poll number 2. We've talked about the economics of valuation. Valuation certainly is based on money. It's a number for a how does impact affect your valuation? How much of a valuation up down can I get from impact creation? A, generally upside. Answer B, impact trendy and it's an upside. Answer C, the impact is the reason for profit, then it's embedded in the valuation already. Answer D, it's between 5 to 10. Answer E, it's generally between 10 to 20% downside. Well, 11, answer the poll. Thank you for answering the poll. If the I think the important part of recognizing this answer as the main one, that no profit, no impact. And so when people view your company, it's in money terms, it's related to equity component. It's in a framework that everybody is agreed on, which is that it's about generating profit. So your valuation is about generating profit. And so your impact is only achieved, it's a feature, it could be the dominant feature of your business, but it's a feature of your business. And so evaluating valuing your impact profit potential. And now, certainly, it's not say that it's trendy, then it will present an upside. If it might present an upside of 5 to 10%. What I can tell you is that beggars can be choosers, and if you're in position of strength, certainly you can command the price in the market. A lot of value. The impact that you're creating will be creating a tremendous amount of value. I can think about some education companies right now. I can think about some renewable energy companies. Then they will might put a premium on your valuation, but it's because, or most of them will be motivated by the fact that will be the same, if not bigger, 7 years later when you all sell your shares in the company. So I think that's an important point to make. I also want to make it. So we've gone through a lot of math about creating your startup, and I want to put this in the context of fundraising. And so I want to ask for the entrepreneurs out there, how much time do you think you should spend raising funds? And so question one, should it be 18 months? Should it be 1 month? You're in, you're out. Should it be 1 year? It needs to take time. Should, you know, or whatever, as long as it takes. Maybe another 45 seconds. Okay, so let's see the results. Okay. 6 months, as long as it takes, it seems like there's an equal amount. There's some amount in the audience. There's 20 people who answered the poll. Thank you for doing that. If about 15% of you answer that it should take 1 year. So you're a startup, and your business is to sell products, not to fundraise. Now, there's a really good TV series that to watch. It's called Silicon Valley. It's very fun, and I've enjoyed all the seasons. I think there's 5 or 6 seasons. And there's a moment where one of the CEOs says to the former CEO, or to the founder of the company who was demoted from being a CEO, he says, "What is your product?" The CEO says, "Oh, we're trying to sell a decentralized internet." And then he says, "No, your product is shares. You're selling shares." So as a founder, I think this is a very provocative thought, but as a founder, you have to determine what is your role in the company. Are you? And so most of the founders are selling a product. So you have to ask yourself, how much time away from selling a product do I want to spend? And that's the time you can spend on doing your fundraising. So it's really important to think about your in a way, process that you should go in, get out of, and then continue to sell, because selling is what's going to grow your business. Fundraising is only part of financing. And so what are the good practices when you're doing your fundraising? It's to plan ahead of time, to really make sure you have your pitch, to you talk to your who your investors are, etc. And these are things that you're doing ad hoc outside of your process in a structured way, certainly, but not in a full dedicated way. That your fundraising is actually a process where you already have legal documents, you've got the data room set up, you've got commitment to you saying, "Oh yeah, I'm interested, and I would put this amount of money." And then this is when you go out and you say, "Okay, guys, you said this. Here's the term sheet. Here's the data room. Take a look at it. We're trying to close," and you said you're trying to set a time with to your investor, saying, "I need to have the money in account in 2 months, or in 3 months, or in a month and a half. So we need to go through the process quickly." That's what's going to allow you to really all the time that you're going to have to spend in all the details of the legal process, et cetera, et cetera. So that's a time I wanted to spend because it's an important part of looking at your valuation and not trying to spend too much time on this, looking at your process of fundraising, because this valuation step is really part of your fundraising process. All the things that we've talked about today, and close this webinar and open it for a question. The first element is put your best foot forward. On other startups, other fundraisers, what VCs will be interested in hearing about, what they've invested in, what are comparables in the market, what you should look like, what are important KPIs. Essentially, do your research on performance, metrics, valuation, practices, etc. This is an essential part of your business, and being prepared makes you look good, and looking good makes it easier to receive investments. The second part that we other than the math around the cap table and the valuation from a VC standpoint, is that valuation scenario of your business. You really have to understand what's the reality behind the failure rate. What are the things that can make my company fail? How much risk is there in that? In fact, going back to those annual reports that publicly listed companies issue every year in the US, they always talk about dangers in their industry and the risks they see. 10K report. And so it should be an encouragement for you to say, understanding the risk is not a measure of your weakness. In fact, is a measure of how much you know about your industry and how prepared you are to facing those weaknesses and risks. Also, an important part of valuation takes into account the dilution. Certainly, that will be important to understand that. One point that we didn't make, but I want to in the next 2 sessions, is the amount of cash that you want to raise, and that really has to cover enough fundraise. And certainly when we talk about how much time you're going to spend fundraising, you certainly need to have enough cash that you're going to cover whatever amount of time fundraising anticipation of your next fundraise, given the profit profile that your company has. So that usually will mean 15 to 12 to 20 months of, that you'll have to raise. Today, the webinar will be put online, and I think you're coming at it with all this information. You're saying, oh, wow, that's a lot of information. I think I understand how to value my company now, but I feel like we skipped an element, which is how to present my business model, because it will affect my valuation. We talked about the capital structure, we talked about valuation, and that's a great question. In fact, I want to encourage you to attend webinar number 3, where we're going to talk about important elements of framing your thought process and understanding your business model, and how to scale and to talk and to look and what to look at when you're thinking about its growth. So with that said, I invite you to join us next week. In the meantime, we still have about 15 to 20 minutes to talk about some of the questions that you might have. So leave it open for questions now.
Thank you so much, Thomas. I have a couple of questions for you, and I will start with the first one, which is in fact a double question, but it's a symmetric one. So the question is, does the number of direct competitors in the market drag down the valuation? And opposite, does no competitors or very few contribute to a higher valuation of the startup company?
So essentially, if I can paraphrase this, thank you, Luisa, for putting forth this question. This question really is in essence, brings us back to one of the earliest, which is what do investors look at, and the competition profile of your industry, the barriers that you set around your business, the value add and the innovation that you bring in the industry are important elements to differentiate your product compared to the competition. Why would an investor take make an investment stage company when there's already an established competition? Let me give you an example of one company that succeeded, and it was only bought out because of a corporate in the industry felt like they were lacking that specific element. So Amazon became very quickly a dominant force a couple years ago, and in the span of about, I think, 2 years or 18 months, this company Jetcom put itself together, hired a lot of people, raised, I think, for their first round, 300 million people. There were former industry executives, and they raised 300 million people to compete with Amazon. So that is basically raising money to create a startup that's competing with a fairly amount of competition. It's not a lot of competition. You have a lot of online marketplaces with one dominant one, which is Amazon, but is an incredible amount of competition. So how can you really raise money saying you're going to compete against Amazon? Well, they raised 300 million with their thesis, essentially, we're going to raise 300 million because we're going to be already mature with all the processes and be already ready, bought out by another company that's very large and that feels like they need to develop and accelerate their online marketing logistics, their online sales logistics. And that's what essentially happened. I think within the span of 3 years, there were the biggest retailer in the world. So that's one example. But frankly, you're not going to find a lot of investors willing to take a bet on an early stage company. Every founder will come with a reason why they're different than something that's already in the market. In fact, there's a lot of, for example, the box business. The box business, if I can summarize it, is every month people will pay you 50 euros and you'll send them a box with specific things. So that might be baby products, it might be men's grooming products, that might be skincare products for women. It might be sports products. It might be, food, and essentially that had invested in one or two companies stopped investing pretty quickly because they knew the market dynamics, they knew the economics, and they said, oh, it's already enough. And even the companies that are in that industry aren't necessarily making money, so I'm not investing anymore. So I think you have to understand that if you're raising money, if you don't have a really big differentiator and something that makes your company unique and protects your innovation and uniqueness in the industry that allows you to get customers in a way nobody else can, which essentially is like creating, in a way, being part of a new industry, then it's going to be hard for you to justify any kind of valuation, or it's going to be hard for you to raise money. So that's my answer on this.
Thank you, Thomas. I have another question from one of the participants, and he asks, in a very early stage, the multiple could be really an issue to value the venture. I heard EBITDA multiple is sometimes considered. Could you confirm? Because based on a pure business plan, the valuation can change a lot.
Did I understand the EBITDA correctly?
Yes, exactly.
So it is true that have an operational profit. EBITDA is an accounting interpretation of your operational profit. It's earnings before interest, tax, depreciation, and amortization. Essentially, it's your revenues treated in an accounted way minus your operating profit treated again in an accounting way, and your general expense and administrative costs. And so certainly many startups will be valued on an EBITDA basis, and there's an industry standards. The difficulty is that it's really if you're already generating profit, the math that I went through that applies to revenue also applies to EBITDA. So you essentially can go to do the same math and say, well, you're valued at 4x. You do the same math to bring back the valuation of today. And then you do the same process with an EBITDA. And basically that might give you, for example, that will take into account your margins. That's certainly an example. The difficulty with EBITDA is that sometimes people will think, well, your EBITDA is not representative because 2 years from now, when you've achieved some sort of scale, it's going to be a lot more consistent with where you are where you're supposed to be. And so what I wanted to tackle here is at least the situation where you've got revenue, but operationally at a loss. And that's an example that applies to the math that we did today. If you have an EBITDA, the same applies. You can show your EBITDA progression through time, do the math in the same way, and apply that sort of forward look, backward retro calculation, and see the range of valuation that fall within consideration. And certainly, again, certain investors will have certain preference, and then will apply certain discounts specific to them. So EBITDA is an important element. Yeah.
Okay, I have another question, which for the time being is the last one, and it's, if your market is 80% of SME, how do you value your sales in the next 5 years, and whether you need a marketing plan?
That's a tough question. I would say that perhaps we can talk. I can think of a lot of scenarios of companies that are in that situation. I talked a little about in this. Perhaps there's a lot of I don't know if SMEs you mean like small and medium companies, and you're a small and medium company and you raise money, and how do you look at valuation? I've talked about this already. I think through answering the EBITDA and revenue valuation, I've talked about this. Another way to interpret this question is to think about competition, which I've also talked about. And other ways to think about it is exactly how you think about your business plan, how you build your business case for scalability. That's something we're going to talk about in the next session. So hopefully you've had your answer through some of the answers that I've provided so far and through the webinar itself.
And it seems we're coming to an end at the perfect timing, which is we are close to 6 o'clock. So thank you so much, Thomas. We are looking forward to the next webinar in 1 week's time, the third one in the series. So stay tuned and register for the next one. And before you leave, please answer the poll that is now on your screen. Thank you, Thomas, and see you next week.
Thank you all, and see you, and thank you, Luisa and Denise, and see you next week. Bye-bye.